and welcome to The Money Show, your one-stop destination for all personal finance queries. I am Snehi Shah. You're watching ET Now. We have lined up a power-packed show for you on the last day of calendar year 2024. First up on the show, we'll get into conversation with Trideep Bhattacharya about the outlook for the new year. And in the second segment, we will throw open the counter to get in your mutual fund portfolio queries answered. So do send us your queries on our WhatsApp number 865-797-4571. Remember, you can also email us your queries on the Money Show at etnow.tv. But on that note, let's kickstart the show then and discuss what 2025 could shape up to be like for the markets and what that would mean for your personal finance portfolios as well. Now, as we approach 2025, many of us are thinking about how to navigate the economic shifts, manage our finances effectively, and how the markets are expected to fare in the new year. Trideep Bhattacharya, the President and CIO Equities Edelweiss AMC, joins us on the show to decode all of that. Hi Trideep, thanks so much for joining us on the show. First of all, wishing you a very happy new year. Give us a sense of how you expect the markets to perform in 2025, any Nifty targets if you are eyeing, and also what do you think the broader markets will do in 2025, because this year they've largely outperformed the benchmarks. Do you think this could continue heading into next year as well?
Hello, and thanks for having me on your show, and wish everyone through yourself a very happy new year. With regards to a market outlook for 2025, we actually anticipate a meaningful shift in equity markets, a transition from what I call as politics of elections in 2024 to politics of earnings in 2025. Let me elaborate what I mean. In 2024, political promises and electoral outcomes actually shaped majority of the macroeconomic narratives. And what that meant is we had, elections in more than half of top 20 global economies, and that dominated the headlines. What we will see in 2025, particularly in the first quarter, in the form of tariffs, trade barriers, and various policy announcements coming from US, our own budget, overall, that'll be what we'll call as the politics of earnings, and that'll dominate the first quarter of calendar year 25, which I think could bring meaningful amount of volatility. Post this, of course, after this initial turbulence, we foresee the markets to kind of gradually calm down and earnings to drive the markets going forward. So on net balance, it may be a volatile first quarter of calendar year 25, followed by earnings-driven rest of the year is what we forecast 2025 to be. And watch out for the tariffs and the trade barriers is something that will make life interesting in 2025, particularly in the initial parts.
Okay, Trideep, thanks for that view coming in. Any Nifty targets that you are eyeing? Any levels that you think the Nifty could scale towards the end of next year?
Yeah, I think it'll be from that perspective, while we don't get into very specific targets for Nifty, I think we probably are looking at a bit of a volatility dip in the first quarter of the year, followed by kind of a rise for the rest of the year is the way I would chart out the path. I would probably say that broadly speaking, over the next 2 to 3 years, if you look at India's earnings growth, that should broadly mirror somewhere between 12 to 15% per annum. And I think that's the guide that we have with regards to how equity markets might turn out to be depending on where we are. Again, we can't set out individual targets, but over a long period of time, generally markets follow earnings. And that's how we would kind of expect markets to behave.
Okay, sounds good. Also, could you share with us what's the outlook on interest rate cuts? Given the current inflationary situation that we're seeing, how will that have an impact on individual stock portfolios at a retail level also? And largely, how do you see inflation affecting household budgets in 2025?
That's a very interesting question. This is probably a longer-term question far more than the short-term question. In my opinion, over the next 3-5 years, the world is gradually entering into a more inflationary environment than what we have been used to in the past 10 years. What that means is that in real terms, portfolio returns would be difficult, would be hard to sort of come by. In such circumstances where inflation is structurally higher, we recommend two asset classes could be particularly useful for investors to have meaningful exposure to. One is equities, because equities are the best known inflation hedge when earnings are coming through. And the second is gold, particularly when earnings go pear-shaped or during recessionary conditions, during tough economic conditions, gold is another asset class which kind of tends to hold up best. So if I were to tell your viewers that two asset classes which could do particularly better in structurally higher inflation environment, which we expect it to be over the next 3-5 years, it might be equities and gold. From a near-term perspective, though, given how rates have behaved, we do expect some rate cuts to happen in 2025. Now, given that the pace of the rate cuts might be a little slower than anticipated, but there would be maybe about a 50 to 100 basis points rate cut globally, and India may be slightly shy of that. So investors should brace up for a mild interest rate cuts in CY25, but a broader inflationary environment for over the next 3 to 5 years. I hope I've been able to explain the near term and the medium term from an investor standpoint.
Okay, Trideep, sounds excellent. Where would you recommend to invest in the next years? Do you think safety lies in the large caps, or do you think mid caps and small caps, also the broader markets largely, would also be a good option to invest in going ahead? And what are some good diversification strategies for investors that they can look ahead to into the new year?
So, two perspectives on investment when we think about large, mid, and small. One is, of course, the valuation, and second is the earnings growth. Using this framework, what we find is that the valuations of the large caps are in sync or in line with the 10-year average, whereas valuations of mid and small caps are anywhere between 20 to 40% higher than 10-year average. So they are expensive. But that's just one side of the story. The other side of the story is that the earnings growth of mid and small caps are meaningfully higher than that of large caps. So how do we balance these two? So my recommendation to investors would be that go for a rightful mix between the large cap, mid cap, and the small cap, so that one can navigate through a complex environment where one segment has valuations in favor and the other segment has earnings growth in favor. So in that context, if I were to look at within equities, for a conservative investor, typically a flexi cap fund, which has a higher proportion of large cap, does quite well. For a moderate risk investor, we would go ahead and recommend the multi-cap funds in the market. They tend to be a right mix of large and mid and small, so a right mix of valuations and earnings growth. And for aggressive investors or investors with outlook of 5 to 10 years, we would recommend the mid-cap funds. There, of course, the weight is loaded more towards mid and small cap, but as long as the horizon is long enough, I think that's the part of the portfolio which will give you the best amount of returns. So different types of funds for different types of investors, and put into the spectrum of valuations and earnings growth. This is how I would look to allocate money over the next 3-5 years.
Okay, thanks for that view coming in. Trideep, also shed some light on which sectors look good heading into the next year. You have real estate and pharma that have outperformed the rest of the market. They've done phenomenally well this year. On the other side, you have IT in focus once Trump comes to power again in the US. Tell us what the outlook is for a couple of these sectors going ahead, and also the ones like consumption that have been lagging. Do you think that could see a turnaround or some recovery, some sort of respite in 2025?
My sense is that the upcycle that we are seeing with regards to India over the next 3-5 years will continue to be driven by manufacturing. Of course, in the current calendar year, in CY24, we actually saw a bit of a dip. That's because we had elections and decision-making took a hard stop. But I think that is likely to change as we get into CY25. So manufacturing is one area where we certainly think the earnings are likely to be resilient. Couple of other places where we have added to weights in our portfolios over the last 3 to 6 months have been IT and real estate, and they have done quite well for us. We have also added weight to NBFCs, where we think as the rate cuts stand to happen in calendar year 25, they might stand to benefit from the same. And finally, I would position consumption as the dark horse of calendar year 25. I think we will start off with weak set of earnings in the first quarter or so of calendar year 25. But as the year progresses, driven by a turnaround in rural economy, by better rains and better discretionary income in the hands of rural population, we think there could be better days ahead for consumption if you take a 2 to 3 year view. And hence, I think from a consumption standpoint, this year, which is calendar year 25, could be a year where we could gradually accumulate shares in this segment, only to reap benefits over the medium term, which is 3 to 5 years.
That's an interesting take, in Trideep. In fact, my question to you is just on that. Based on the earnings that we are expecting to see in January, January is going to be a very event-heavy month. You have earnings, you have adjustments coming in, you have Trump taking over the reins in the US. Lots is happening. Amid all of this, if you are bullish on consumption, you are calling it a dark horse, how would you play the consumption space? Would it be via pure play FMCG names? Would it be via some of these new age tech companies, recent listings that have been doing well? You have QSR, quick commerce, that's doing pretty well. QSR is finally finding its footing once again. On the other side, you have retail. Footwear stocks, your fashion stocks, all of this is making up the entire consumption basket. Amongst all of these, how would you position your consumption play?
We would actually position, or we would sort of we anticipate a weak start from consumption from calendar year 25. We think that the December quarter numbers, which will come in January, would actually show that consumption has been relatively weak in the last 3 months, and the outlook is kind of middle of the road, not too bullish, not too bearish, particularly on the urban side of consumption. The rural side of the economy will show gradual recovery overall, and companies, we expect managements to talk about the same. But if you were to look at an aggregate, the December quarter numbers may not show great deal of enthusiasm for the consumer names. However, when there is lack of enthusiasm, there are better valuations. So I think overall, post the results, or as the results come through, you would, in this volatility, you might find that some shares in the consumption basket at reasonable prices, where I think from the 3 to 5 year perspective, money making could work out quite well for investors. And that's the reason why we call it a dark horse, in the sense we will start off weak the year, calendar year 25, and improve gradually through the year. So we expect a weak start from consumption. And in fact, we expect Q3 across the market to be slightly lackluster, but over a period of next 2 or 3 quarters, the economy will gradually pick up, and so will the consumption.
Okay, and Trideep, just on a quick departing note, if you have any words of wisdom, words of advice for retail investors heading into 2025, or top 3 advices that you would like to give to them overall for the outlook of 2025?
I think the first thing that I would say is and it's a well-defined adage that time in the market is a lot better than timing the market. So over a period of time, look forward to benefit of compounding, and that comes with the amount of time that one spends in the market. That's one. Second, even though we were actually quite skeptical as the market about mid and small caps, they have delivered better earnings growth than the large caps. So go for a mixed portfolios where there is a mix of large cap, mid cap, and small cap, where the portfolio manager has the leeway to balance out the holdings based on where he or she finds the right opportunities from an investment standpoint. And finally, this is India's decade. The earnings growth that we are likely to see over the next 5 to 10 years, which would be, in my opinion, the best years of India's earnings growth from an India Inc. perspective, as new business models get to list and present investment opportunities for investors overall. So don't miss the India earnings growth story in the form of Indian equities. With that, I would wish everyone a very happy new year and happy investing.
All right, Trideep, very excellent words of wisdom coming in for our viewers. This has been a very fruitful chat. Thank you so much for joining us on ET Now and speaking to us. And once again, wishing you the best of the festive season as well as a very happy new year.
Likewise.
All right, viewers, on that note, we'll slip into a very short break on this edition of The Money Show. We'll be right back on the other side. See you soon.